I'm going to take you through my weekly prep. You're going to go along with me because I'm going to share my experience, how to view the market. When we get into a bit of a pullback like this, like the NASDAQ has pulled back about 5% currently, newer traders can get a little nervous. You don't really know how to view the markets. Do you buy the dip? Is it going to keep going down? The news is saying that everything is all bearish, and the more that the market goes down, the more bearish the news is. So I just want to walk you through. We're going to talk on technicals, on major indexes, and some of the major names that are moving. We're also going to talk fundamentals, what's really driving this market, in the near term, but also further out. What can we expect? We're going to talk a little bit about cyclicality. So let's get into some charts, and I'll walk you through this. Okay, so here's NASDAQ futures. Let's go ahead and start doing some technical analysis. I'm gonna put a support line in here and I put a resistance line in somewhere about here. And if we were to put a trend line in here, I'm just putting this in to show you like this trend line's broken. We are full on in consolidation mode here now. Let's zoom out. This is something you may already know. Like we've been going up. We've been going up for a while. Something like that. So this is a multi-year upward trend. Now we expect this multi-year upward trend to continue based on the AI theme. That's reasonable. Is it going to continue right now? This consolidation at the top is telling a story, isn't it? This consolidation at the top is saying that we are extended. We're extended from the weekly trend. And this daily trend that we identified is broken. Is it reasonable to get a pullback? Yeah, it's definitely reasonable to get a pullback. Is it reasonable to get a pullback to 20,000 down here somewhere? Well, no, that would be like almost a 20% pullback. The Nasdaq's not going to have a 20% pullback. But based on this chart, it is reasonable for us to have some sort of pullback or digestion, some sort of consolidation on the Nasdaq, which is what we're seeing. So if you're getting nervous about this move here that we pulled back this week, it's healthy. This pullback is healthy. We can't just keep going up forever. We need the market to take some digestion. And on a bigger level, you've probably heard the news that basically what's happening is these tech companies have spent like a combined total of $240 billion on the AI theme. And now over the past recent earnings, they on their calls they've identified that they want to spend a combined $650 billion dollars. So they're marching towards $1 trillion. Some analysts are saying like it's going to take 1 trillion, maybe even 2 trillion to do what they're trying to do. But investors are saying, well, we want to see something back for that. Like $240 billion is a lot of money. They want to see a return, which is reasonable, right? They want to see basically like blank checks have been cut for AI. There's been no, when you start any normal project, it's like, okay, this is exactly how I'm going to spend the money. This is what the labor is going to cost. This is what the materials are going to cost, or the supplies, or whatever it is. Logistics are going to cost this. Marketing is going to cost this, right? There's been none of that. They cut a blank check for $240 billion dollars and said, go to town. And the tech companies have said, we're in danger of not spending enough money. We just need to start spending. So now investors are saying, well, hang on a sec. Before you spend another 650 billion, I want to see that you are using the first 240 billion and seeing some sort of return on that, which, is reasonable. And that is reflected by this consolidation right here. Uh, and of course, the NASDAQ, everybody knows the NASDAQ is very tech heavy with companies. Let's move over to the SPY. Look at the SPY on the daily chart here. The SPY is holding the trend, the daily trend. Pop over to the weekly quickly. Here's the weekly chart. There's the trend for the SPY on the weekly. We're nowhere near it, and the SPY is holding the trend on the daily chart. So that's a good thing. Is the SPY going to enter some sort of consolidation? Guys, don't be surprised if the SPY doesn't drop out here a little bit. Okay? We've gone a long ways over the last couple of years. I mean, the SPY has more than doubled in the last couple of years, which is pretty epic. But it probably does need some sort of digestion phase, even if it's only a month long. It needs something. Of course, the big news is the Dow Jones. Here's Dow Jones futures, and the Dow Jones has broken out, which is incredibly bullish. So what's happening here is that you may know this already, tech companies are taking a breather. And then a lot of that money is rotating into other stocks, like just average companies that need to catch up to tech companies. The Dow Jones is reflecting that the average company needs to catch up. Here's another one. RSP is the equal weighted S&P 500, right? Because normal S&P 500, they just end up buying basically an equal allotment, equal, say, for example, an equal number of shares of a specific company. But those shares are all worth different amounts. So actually what happens is it's not equal weighted. The companies that grow bigger faster end up being an outsized portion of the actual S&P 500, or it's more pronounced with the Nasdaq, right? The tech companies end up comprising an outsized amount of the Nasdaq 100. So it's the same for the S&P. So we come up with the RSP, which is the equal weighted S&P 500, where it's basically like so much money for each company. They all get a block of money, and that never changes. It's always going to stay like that, and it's all going to be equal across the board. You can see that this equal weighted S&P 500 broke out on Friday. So that's what's happening. We're coming out of tech companies and going back into normal companies, playing a little catch up, letting the tech sector breathe. And in all fairness, probably what investors are going to want to see is they're going to want to let it breathe till next earnings report and see like can these companies come up with more profitability. And it's not that the earnings came in poor. The earnings didn't come in poor for most of the tech companies. It's just that the amount of money that they spent over the last year and a half versus the amount of earnings growth that they had, they're not matching up. When investors like institutions are doing the math, it doesn't add up. So that's why it needs a breather. And that's why a lot of money is going back in. Another one is IWM, right? IWM is the small caps and it's coming back. It continually keeps breaking out and it's coming back again here on Friday. Again, just the average company, not necessarily tech companies. So that's what's happening right now. It's mostly just the tech companies that are having a pullback. Here's the Magnificent Seven ETF, and you can see here, like they're not even really down. Like again, there is a consolidation here. There's a consolidation zone. It's not down. It's not bearish for tech. It's not bearish for the stock market. We're not bearish at all. It's just that the biggest companies in the world, investors are saying, let's give them a moment. They spent a lot of money. Let's just give them a moment to see if they can get a return on that money that they've spent. Okay, so moving on, let's take a look at gold. I meant now, as I mentioned, gold is now a momentum name. Gold has been a momentum name since about here, since about September of 2025. This is all a momentum chart coming up, have a little consolidation, trying to break out, kind of half cup and handling a bit in a weird way. We come here, we take a breather, and then we just scoot up. And like the volume, this is the big thing that makes it identifies it as a momentum stock. Look at the volume here. Like the volume just keeps increasing, starts going nuts around April of last year, really goes nuts in October of last year. This is a momentum chart. So why am I saying that? Because you're no longer trading gold. This isn't the commodity gold. This is a momentum chart, and it looks like a typical momentum chart. Big moves up, big red days, lots of volume, having these consolidation periods on low volume. Let's go to the weekly chart. You can see it a little more pronounced here. Big candle up, down, consolidation on low volume, kind of grinding back up on low volume, short squeeze at a key level of 500, big short squeeze there. And then we come back down and we're kind of consolidating again. Are we going to do this sideways pattern and then break out again? I don't know. I don't know. We could, based on typical momentum chart behavior, we could. But there's one very important thing that's being highlighted right now. It's the whole Kevin Warsh thing. So Kevin Warsh wants to decrease the size of the Fed's balance sheet if he gets appointed as Fed chair. Takes over for Jerome Powell. Now, Jerome Powell has, a crazy legacy. He's been through some crazy stuff, and he's, arguably done some pretty dramatically good things. His legacy is strong, but one of the things he will be remembered for is inflating the Fed's balance sheet. And so, if you're not familiar with the process, the way that the Fed prints money is they don't just necessarily print a bunch of money and give it to Donald Trump or the government. What they do is they buy US government bonds, they buy treasury bonds. So when we see this, this is the M2 money supply going up. This is the amount of US dollars in the world. This is directly proportional to the amount of US government bonds that the Fed is buying and holding. And they get the interest that comes off those bonds. Now, they keep what they need to run the Fed, and then they give the rest of that interest over to the government to help with the government's balance sheet. But if you really think about it, who's paying the interest on the US government bonds? Right? It's the American people. So the American people pay the interest on these bonds. The Fed uses some of the interest to run the Fed, and then they give the difference back to the American people. Are they really helping the American people? They're just taking that money from the American people. So what Kevin Warsh wants to do, and I mean, sorry, this balance sheet is wild. I'd have to here, let me look it up here. Okay, so this is the size of the current balance sheet of the Fed. So the number here is about 6.5 million. But what I want you to notice here is that the units are millions of dollars. So this is 6.5 million. So it's actually 6.5 trillion is what it works out to be. If we put it into, I put it into ChatGPT here, did the math, it agrees with me. $6.6 trillion is what the Fed is currently holding on its balance sheet, which is astronomical. And it is the reason why gold was going up. Because as they keep printing money, there's more dollars introduced into the world. That means gold goes up. But if Kevin Warsh comes in and he reduces that Fed balance sheet size dramatically, then this goes down. The amount of dollars goes down. But I know what you're probably thinking, well, there's still a lot of countries out there that are moving from US dollars to gold, and that's not going to change. I'd like to challenge that a little bit. I'm not bullish on the US dollar, but if they stop printing money and dramatically reduce the size of the Fed's balance sheet, here's the thing about gold. Gold costs money. Whether you own physical gold, like a country owns physical gold, and they have to create some sort of really secure warehouse that's climate controlled and all sorts of stuff to store their gold, it costs them money to store this gold. Whereas if they just go on the open markets and buy US government debt, it's a store of wealth that pays them 3 or 4% or whatever the coupon rate is of the bonds that they're currently buying. If the US dollar can get themselves back under control, aka reduce the Fed's balance sheet, reduce interest rates like Kevin Warsh wants to, and stabilize the quality of the US dollar, then there will be at least some going back into the US dollar. Because at the very least, if they want to keep gold reserves, if a foreign nation wants to keep gold reserves, they have to pay to keep those gold reserves safe. Whereas if they buy US government bonds, they could potentially still have a solid store of wealth and be able to pay for the cost of storing their gold. Just as a scenario, just to get the wheels turning. From a momentum chart basis, I do have an entry order. I placed an entry order here on Thursday at 5,050 because if this breaks out as a momentum name, if this breaks out, it'll at least go back up to 5,500 and I would take that small move. But it's a stop entry, so it only gets in if we break out because I don't trust this chart right now. Like I said, from a momentum chart standpoint, sure, this could go higher. From a gold standpoint, it's a big question mark. We have to see if Kevin Warsh is actually moved into that Fed chair position. Then we have to see what his policy intentions are. And then we can see where gold and the US dollar are going to head. So for this chart, if you like to trade this stuff, what you need to do, go check out some of my other videos on how to build edge. And what you're specifically looking for is a momentum strategy. I know most of you were looking at this because it was exciting. Gold is moving. That's exciting. If that's something you like, then great, lean into it. But what you're looking for is not gold specifically. You're looking for a momentum strategy. So last year it would have been uranium or CoreWeave or something like that. So that's the kind of stock that you're looking for in that specific time period when we start getting volume coming in, we start getting this grinding higher, we start getting these big dumps into short squeezes. That's the kind of chart that you like to trade. So that's what you want to look for. Uh, let's discuss cyclicality just real quick. It's very simple. How do we usually perform in February? So I pulled up this chart. This is since 2010. Uh, and it looks like February we usually do about 1.12% on average. But if you go through and dial down, I mean, we have some good years. We have some not so great years, not even 3% down. Here's what we've never had. Well, I guess we've had one year where we had minus 7.9%. It was 2020, so not a great year to include. Every other regular year, we don't even have 3% down. So this is, of course, cyclicality for the SPY. And if you remember on the SPY here, we are on the month, we're coming back to kind of flat. Like we're not, as of Friday, we're not even really down much in February, and it's early in February too. February is typically a stronger month, and when it's bearish, it's not even that bearish, generally speaking. Let's go back and see if we can find cyclicality on the NASDAQ here. So here's cyclicality on the NASDAQ. You can see here we average 1.23% positive in February. We've had a couple of months where we were down, 4.5, 6%. But again, this 6% was in 2020. So, that's not a typical year. Um, there's not an overabundance of bearishness in February. Can this year be different? Sure, it can be different, but I don't, based on that, what I'm really getting at here is that I, and you guys probably know, I trade mostly the NASDAQ. I'm not really expecting the NASDAQ to go down any further here. Uh, there was a fair amount of volume on this candle on Friday. Let's see if we can get some conviction on it. Let's see if we can break out past the close and get another green candle here. I don't like we average 1.23%. So February is not like a really strong month. July is a really strong month on average. February is just kind of mediocre average month. So based on the fact that it's average and we got this over 5% pullback, that's why I bought. I thought we could get, I mean, I already had a position. I didn't sell it. I wasn't worried. Would I have sold it? Of course, I would have sold it. I do have risk management. But I added in here because I expect this to come back. I don't know how long we're going to chop sideways. That's a good question, and it depends on a number of factors. One last thing I want to mention, news. Okay, the news does not drive the charts. The charts drive the news because these people are economists or they're reporters at CNN or Bloomberg or Barron's or wherever it is, and they look at a red candle and come up with a story about why that candle's red. But they don't have a hot clue. They don't have a clue any more than any of the rest of us do. And I promise you that if that candle started out red at the beginning of the day, they would have all sorts of bearish narrative for why that candle's red. And if that candle went green by the end of the day, they would completely flip their story and they would be finding all sorts of reasons why this candle is now bullish. They have absolutely no idea. But there are news items that we can pick out. One was the Kevin Warsh thing, which everybody kind of is aware of. It's all over the news. So there's the Kevin Warsh thing. The other thing is that investors just want to see earnings growth that matches the $240 billion spend, not to mention the additional $650 billion spend that these tech companies want to spend on AI. So those are the two news items that mean something. All of the rest of the news that you hear is just filler. It's just noise, it's dopamine hits, it's fear mongering, it's trying to get your eyeballs glued to CNN or Bloomberg or whatever it is that you watch. So you have to be very careful with the news, and that's where I come in. I will tell you what news stories matter and which ones don't. So let's go ahead and I'm going to just pull up a quick pros and cons list, like a bearish versus bullish, and we'll go over that and try and figure out what the actual view is of the market. All right, guys, I'm just doing a bullish versus bearish, a list of items, and I've added a case for neutral here. So first of all, the AI theme is bullish and is big time bullish, and it will continue to be bullish, and we will continue to go higher. This year is definitely going to be a bullish year in most analysts' opinions. So we will get there. We will get to bullish. Um, Maybe not in the short term, though. Uh, Kevin Warsh wants to cut interest rates, which is not being highlighted. He wants possibly another basis point cut, which is significant. So almost another 25% cut in current interest rates. Bearish is AI spend right now. And it's only bearish at the moment, like I mentioned, because the return is not matching the spend at the moment. But that will change. So this is a big almost question mark because this one's going to change. Potentially shrinking the Fed's balance sheet, right? We talked about that. Kevin Warsh wants to quite a bit, by quite a bit, shrink that Fed balance sheet. And the market views that as bearish, but long term, this is actually bullish because this strengthens the US dollar, it strengthens the US economy, and to be honest, it's just straight up adult and responsible. It is probably the most responsible thing that the US will have done in 30 years or more, fiscally speaking. So, but in the short term, this is probably bearish. Neutral items, though, the chart. The chart, it can't break down, it can't break down, and it can't break out. And what do I mean by that? I don't mean that it's not possible for it to do that. What I'm talking about is that it's tried breaking down here. It's tried breaking down here. It's tried again to break down there. Can it break down? Yeah, it can. It's possible that it can, but it's just not. It can't seem to break down. Also, it can't break out, right? We haven't been able to break out here and here and here. We can't seem to break out to the upside for the Nasdaq. And it's not that much different for the S&P. It keeps testing this trend line, and then we're not also really not breaking out. So the Dow Jones did break out. The RSP, the equal rate S&P 500 broke out. Um, we are seeing some breakouts. So overall, I am kind of calling this consolidation here. And that is the main thing that I want to point out. The bearish items are not permanently bearish. The AI theme is still strong. Cutting interest rates strong. Case for neutral is Kevin uh, Kevin Warsh nomination. Nomination isn't confirmation. He still needs to go through the process of getting heard by the Senate and actually implemented into this position. So there's a lot of question marks around that. So because of all this, the fact that the bearish items are not truly bearish, they're going to flip and become bullish at some time. There are bullish items on the table, but more than that, the major issues right now are question marks. Like, are we going to get more revenue from the AI spend? When are we going to get more revenue? The market wants to see that. What is Kevin Warsh going to look like as a Fed chair? And we actually need to see that chart break out. But the chart's not going to break out till we get some more answers. So the market is firmly in consolidation mode right now. Do I expect it to chop around and stay there? Yes, I expect it not really to break down. I don't expect that the Nasdaq gets any worse. The S&P could have a moment similar to what the Nasdaq has had, but based on the S&P equal weight, I mean, it looks pretty strong. Let's see if it can continue to follow this trend line for now. But certainly the Nasdaq, I expect to firmly be in consolidation mode here. So that's my take on the market. That is how I come to my view of the market. Again, if you want to trade any of these strategies mentioned, we talked about momentum as highlighted by the gold chart here. I trade the NASDAQ, which is primarily a trend following strategy. Um, if you want to learn how to trade this stuff with Edge, I mean, we can talk about how to build a market view, but that is just kind of what we expect to happen. How to build Edge is a process that you go through to pick a strategy and refine it, track that strategy. You want to do some back testing to try to understand that strategy better. And over time, you get better at trading, and more than that, you see what works, and more than that, when you see how it works, you have confidence in that strategy. And that's what allows you to trade. That's what gets rid of 90% of your psychology issues. Listen, the website is up and running. Go ahead and check out some of our other videos on how to develop Edge. Check out our backtesting tutorial. If you're interested in this, give me a like, subscribe. We're aiming to bring real content to people. I'm tired of seeing the hype out there. It's not real value. Unfortunately, YouTube pushes hype. YouTube doesn't care about real content. YouTube pushes hype. So likes, subscribes, comments, shares, they really help out a lot. I hope you got a lot of value from this video, and I look forward to seeing you in the next one.